right, the first question is the one everybody on Wall Street wants to know. When are you going to raise rates? Can you give me the exact date and time? that would help a lot. Seriously. The targets now that you're looking at, the dashboard, as Chair Yellen calls it, kind of vague. What do you need to see before you decide it's ready, it's time to raise rates?
Well, that's a good question, and Chair Yellen has laid out a dashboard, a lot of labor market indicators. Those are very important. Labor report was strong a couple of weeks ago, 288,000 payroll employment, which is a good number. When we started the QE3, I tried to mention that we needed to be seeing 200,000 in order to think about tapering. That was a long time ago, and we were obviously well above that, so doing very well. The unemployment rate's 6.1%. I think the best news there is that the labor force participation rate was flat, so we didn't see a reduction in unemployment on the back of a further decline in the labor force, so that seems more sustainable. And yeah, I just think that labor is doing a lot better, especially relative to the most recent GDP numbers. I think forget about the first quarter; everything else is looking much better, and so I think that's a good thing. In terms of dashboard, I'm going to be paying a lot of attention to the inflation outlook because the unemployment rates come down very nicely, but inflation continues to be below our 2% target. It's been below 2% for quite a long time. And I think we need to get up to 2% in a sustainable fashion, and that's probably going to be one of the biggest issues.
Well, how fast do you think that's going to happen? Jim Bullard, the St. Louis Fed president, said this week that you're going to overshoot, that by next year you'll be running well over 2%, 2.4%, 2.5%.
Well, some people do have forecasts that are above 2%, but others have them below 2%. Part of that's going to come down to how much of the most recent couple of months of inflation has been a transitory increase. In inflation, I think that the underlying fundamentals continue to indicate to me my inflation outlook is for 1.5 to 1.75 for a couple of years, and I don't expect to get up to 2% for a few years. So I think there continues to be pressures that are going to hold that down. If we get above 2%, then that'll be a sign that things are doing better, I think. And frankly, it's not a catastrophe to overshoot inflation by some amount. 2% is our target. That doesn't mean we have to stay below 2%. We need to average 2%. So even a 2.4% inflation rate, if it's reasonably well controlled and the rest of the economy is doing okay, and then policy is being adjusted in order to keep that within the under 2.5% range, I think that can work out.
What causes consumer inflation, in your view? Broad range of things, or is it wages that's missing right now?
Well, I think wages are going to be an important part of the ingredient here. In terms of the sustainability of inflation, getting to 2%, maybe being above it, but staying at 2%, historically that's always been associated with strong wage growth. I mean, if you think about the 70s when we had very strong inflation, much too strong, of course, that was associated with cost push and wages increasing. So wage growth has been on the order of 2 to 2.25%. And a sustainable rate of nominal wage growth is average productivity growth plus target inflation. That's 1.5 plus 2. So that's 3.5% would be sustainable. We're well below that. So I think we should be looking for wage growth to get up to 3.5%. That'd be a sign of sustainability.
NAIRU, as economists call it, or basically potential growth, is the intersection of your two mandates. What do you think that level of unemployment is now?
I think it's more like the normal rate that we used to think of before the crisis, something in the 5 to 5.25% unemployment rate. That's what I take to be the sustainable rate. So at 6.1%, we still have quite a ways to go.
You see a lot of slack still.
I do. And I think that the low wage growth to date is indicative of that as well, plus the lower inflation. So I think there are many signs of continued resource slack.
Well, do you believe or give any credence to the new neutral theory that all of these former relationships aren't going to be the same, and we're going to see lower levels of interest rates, higher unemployment going forward?
Well, I think that there are a variety of reasons to believe that sustainable real interest rates are going to be somewhat lower than before the financial crisis. One thing that we've done, a lot of people have done, is they've marked down their assessment of trend real GDP growth. And The way the theory works is if your potential growth, if trend growth is marked down, then it's likely, according to growth theory, that real rates would be lower as well. Now, how much lower? That's a good question. I don't know. I've moved down my assessment a little bit, as have many people with our so-called long-run dots for the sustainable funds rate. But I think that's a question, and we'll begin to see how that plays out as we ultimately increase the funds rate. Then the question is it still very accommodative, even though we've started increasing it, or is it actually more restraining? It's going to depend on the gap between that, and where inflation comes out will be a big test for that.
You can essentially hit your targets for inflation and unemployment around the end of this year if things continue to proceed at the same pace that they have over the last couple of months. Then Chair Yellen said you're going to wait, whether or not it's 6 months, but you're going to wait. What are you waiting for?
Well, as I look at the SEP submissions, I don't think we have a good consensus that we're going to be at our targets until the end of 2016. So I don't think it's quite as early as you were suggesting. I do think that we're going to continue to see progress this year. I'm looking for a 3% growth rate on a run rate basis from here on out for the next 18 months, GDP growth. And the unemployment rate should continue to come down. Probably not quite as much as it has, because I think the labor force participation might flatten out, and that would contribute to slower improvement in the unemployment rate. But I think the labor market will continue to improve. I just think that it'll probably take until 2016 for us to get much closer to that. And again, the real test is inflation going to get up to 2%? Is it going to be confidently 2%, maybe just a little bit above that? We've been below it for an awfully long time, and we should be averaging 2%. When it's confidently sustainable at the target rate, then we should think about our adjustments.
A lot of talk about financial stability from the Fed recently. What would be wrong with raising interest rates a little bit, say no more than 1%, to maybe mitigate some of the reach for yield, give savers a little bit of a break? Would it have that much of an effect on inflation, on unemployment, and the economy's prospects?
Well, it's hard to have a lot of confidence as to whether or not it would have a large effect on unemployment and inflation as opposed to only a modest effect. I think directionally it would slow us down. I don't think we would make as much progress on the unemployment rate. We'd still be, not getting back to our targets as quickly as we should. And inflation, if you do that in a period where you're still not even sure you're going to get up to 2%, I think that would be a very bad trade-off to be making. I think the other aspect of that is, if you really think that you want to dampen financial instability risk by increasing interest rate, it probably takes a much larger increase in interest rates than what you're suggesting here, 1 percentage point. Other foreign central banks have tried to make adjustments like this. The Riksbank and the Norges banks have done this a little bit, and I remember Chairman Greenspan giving a Jackson Hole speech back around 2002, and he said the problem is, if you really want to attack financial instability with the funds rate, you need to really increase it a lot, because if you increase it just a little bit, then the markets kind of test you out, and then they say, oh, well, that's all you're going to do. It's not really going to have that big of an effect. I'd worry about that and whether or not it really affected the slope of the yield curve, because if it ends up still being relatively flat, even at a higher level, there's still the potential for carry trade. Well, if it was steeper.
Speaking of the funds rate, the minutes suggested there was a discussion of recalibrating what goes into the funds rate. What are you talking about, and why do you feel that's necessary?
Well, the number of participants on that form the basis for how the effective funds rate is calculated is much smaller than everybody who trades in the Fed funds market. Basically, that's the issue. And so there are other sources of data that we are going to have access to, which could give rise to a firmer estimate of that. But that's a relatively technical question.
Well, last question then. When you do get to the exit strategy, what do you envision as the Fed's primary tool?
Well, as you well know, the minutes came out just yesterday, and they talked about that. We've been having discussions about which short-term interest rate we would be using in order to affect a little more financial restraint. The funds rate, with our very large balance sheet, it's going to be tougher to put pressure on reserves in order to tighten that up. we have available. We can pay interest on excess reserves and increase that. That's administrative rate, so we can absolutely increase that. And that would change the incentives for bank lending. Remember, this is at a time where we think that bank lending might be proceeding too quickly in order to be causing more inflationary pressures. There's probably not as much lending right now as we would like, but we could tighten things that way. And then there's a new product, the overnight reverse repo rate, which we've been testing, and we can also increase that. We're having a lot of discussions about that, and there's more work to do there.
Speaking of IOER, that's set by the Board of Governors. Is there a political problem here that the bank presidents wouldn't technically be part of that?
I'm not really concerned about that. I think the way that this works is that we have the FOMC meeting. We talk about economic conditions. We talk about what we need in terms of the direction of short-term interest rates and how they need to move in order to affect more financial restraint. And we would be looking for short-term market rates to increase as well. The overnight reverse repo rate is going to be something that we will use. The question is, will it be in a leading fashion or in more of a passive fashion? That's a market rate that would be under the purview of the FOMC. So we work well together. I'm not concerned about the governance issues.
Before I let you go, the Barbara Walters question. If you were a dot on a dot chart, what kind of dot would you be? Where are you in terms of where you see interest rates?
Oh, well, I've said for quite some time that I still think that highly accommodated monetary policies are appropriate. When we put our submissions together, we say that it should be what's appropriate policy. And I think that it could well be the case that it should be early 2016 before we lift off. So I'm one of those.
All right. Thank you very much.
Thanks.